Welcome everyone, and thank you for joining me today for a quick video on the most frequently asked questions I see in practice. My name is Eli Noff, and I'm a partner and chair of tax controversy at Frost Law. I field a lot of prospective client phone calls, and one of the most frequently asked questions I receive is, I heard on the radio that I can settle my taxes for pennies on the dollar. Is that true? Kudos to you listeners and to my prospective client callers for being skeptical and calling a tax attorney, or watching this video to take a bit deeper dive. I'm going to spend just a couple minutes going over the basics of federal offers in compromise. As always, feel free to call me to discuss any questions you may have after watching. While there are a few different types of offers available, today we'll discuss offer in compromise doubt as to collectability, which basically means I want to settle because I can't pay. Before considering an offer in compromise, ensure that you filed your outstanding tax returns and paid estimated payments for the current year. When coming to settle with the IRS, they want to make sure you're drawing a line in the sand and will not continue to owe if they agree to settle. Also, owing again in the future can result in the unwinding of an offer in compromise. To properly evaluate an offer, we have to discuss the term CSED. Collection Statute Expiration Date, CSED. Basically, the IRS has 10 years to collect a debt before it expires. There are exceptions and actions that stop that clock from running, and this should be evaluated before filing an offer in compromise. There are two steps you need to take in determining eligibility for an offer. Step 1. If the IRS determines that your income and assets can fully satisfy the liability within the 10-year period that CSED we talked about a minute ago, if so, the IRS generally will not consider an offer in compromise doubt as to collectability because they can collect the balance within 10 years in full. Why should they settle? If you're unable to pay within the statute, then you proceed to step 2, determining what the offer amount is. The IRS formula for settlement is based on what's called Reasonable Collection Potential, RCP. RCP is calculated by adding your disposable monthly net income on one side with your net equity and assets on the other. You add those two and you get your offer amount. Now, monthly disposable income is computed essentially by looking at gross income minus allowable IRS expenses, that's an important term for another time, equals net disposable monthly income. The IRS gives you two options when computing the offer amount. They give you the lump sum offer or the periodic payment offer, and they are what they sound like. The lump sum offer is essentially the IRS saying, look, pay us within 5 months, give us 12 months disposable net monthly income on one side, plus your net equity and assets, and that is the offer amount to settle the liability. How to compute disposable monthly income, what's net realizable assets, what's equity. These are deeper dives that we'll have to take on another video or give me a call to discuss. But essentially, if you want to do the lump sum offer for the lowest amount, you would essentially look at 12 months disposable income plus net equity and assets equals reasonable collection potential, RCP. RCP is your offer amount. The other option is the periodic payment plan. And the periodic payment plan is what it sounds like. It's a 24-month payment plan offer in compromise. But in exchange for getting 24 months instead of 5 in the lump sum offer, you have to do 24 months disposable net monthly income on one side of your offer RCP formula with net equity and assets. So the only thing that changes between the two offers, the lump sum versus the periodic payment, is the amount of net monthly disposable income that factors into the offer. On the lump sum side, it's 12 months disposable monthly income. So it'll be a lower offer amount than the periodic payment plan, which requires 24 months disposable income. So bottom line, like a good law school question, the answer to our opening question is it depends. I hope you found this quick video helpful, and stay tuned for more to come on frequently asked questions from a tax controversy attorney. I'm Eli Noff. Until next time.